Good afternoon, everyone. My name is Raphael Karuaihe, and today we will be discussing yet another series from our commodity derivatives, and we'll be touching on basis trading. Slightly a complex concept, but I'll just take you through a couple of examples just to see if we'll make sense out of it. Right, just basic definitions of basis. Now, typically the basis that we are talking about is just simply the difference between your futures price and your spot price. And there are a couple of factors that attributes to the difference in the normal course of trading between what you would see in the physical market and in the futures market. We also refer to it then as the cost of carry, and that's really just the difference between your futures and your spot price. And your cost of carry is composed of your storage costs, then plus your interest on capital, because you see in many cases your traders or your farmers, whoever is a hedger, may have to then maybe either borrow money from a bank to be able to trade or to plant or whatever. So to be able to take these positions, we take the cost of interest on capital borrowed from any financial institution into account as well. So we will go through a couple of examples to just justify as to what we mean by basis in general. One which we are not going to cover today is a special case of a basis which we call spatial basis, and that is where for example, you would know that when we trade like a white maize contract, it's the traded price is for a specific reference point, in our case Randfontein. So in the case where you sit in Durban or somewhere else, the difference between your Durban and Randfontein is actually another form of basis which we call, typically the common name we use is location differential, but which is in essence spatial basis, which is the marked difference in terms of the physical locations which you find yourself in, and that's for later. For now, we would assume that you trade the reference point, which is Randfontein, and then in that case your spatial basis then would be zero. So we also have a common term for basis, which is the forward curve. So depending on which market you trade, really, some people would feel comfortable using different terminologies. But in essence, it's just the difference, as we said, between your futures price and your spot price. I thought this would be quite good to show you in a graphical representation. This is just a theoretical abstract there. You see the dark or the thick line representing your cash price of a particular commodity, and this is then your line of your futures price. And again, because of the efficiency, supposedly the efficiency of the market, when the futures price or the futures contracts expires, when it gets closer to expiry, we should actually see convergence between your futures price and your cash price, because ultimately when your futures price expires, you then receive the physical commodity, and we can't see why there should then be a difference between your spot price in the cash market and your futures price at delivery. But then you see over the lifespan of the contract, you see this gap between the two, and that's what we call basis. I have here another example. This is a real life graph that I have taken from our data bank, and you would see that the red line represents our July 14 wheat contract, having traded since 20th of August last year already, and until it ended or stopped trading or expired on the 20th of July this year. And this one is the spot market price, which we actually use our spot contracts as a proxy for the cash market. And you really see how this develops, and the gap there is your basis, and how towards expiration of the contract we actually see convergence in the last few months, few days towards expiry. Then what is basis conceptually? What are we saying? We are saying, intuitively, let's take an example of a hedger. This could be a farmer who wants to lock in a favorable price ahead of time for delivery of his crop 3 months down the road. So after initiating a hedge, the primary market risk, basically, that a hedger faces is the change in the initial basis. In other words, we are saying that the basis is actually undiversifiable. In other words, even if you manage your risk as a hedger, typically as a farmer, you can say that I'm locking in a favorable price so that I secure a good price. But the only thing that we really cannot hedge is the basis, because it's purely market driven in a sense, and depending on market fundamentals there, and that is the only risk that is remaining there. But if you know your basis, historical basis in your area, it's also even better for you to be able to then manage it better. I know in the advanced markets, like in the US commodity markets, farmers are very keen and they manage the basis. They monitor historical basis, although it's not something that we commonly do here in South Africa. Basis is said to be strengthening when it becomes more positive or less negative. In other words, the gap between your futures price and your spot price widening is when we say that the basis is strengthening. Yeah. So the gap becomes more positive or less negative. Sometimes in real life we find that the two graphs actually cross, and that's when we get the negative number. Yeah, so, and either way, that is when we say it is strengthening. And again, it is weakening when it is less positive or when it is more negative. Short hedges benefit from strengthening basis. Now, who are short hedges? Typically, in our case, it will be a farmer who is naturally having a long position because he has the commodity, and he has then to take a short position in the futures market to be able to hedge himself, and those are the participants referred to as short hedges. So it's short position holders who are inherently long, and they have to take a counter position to hedge themselves. And we are saying that farmers typically would then benefit from a strengthening basis, and strengthening as per the definition we gave above there. And long hedges, in this case then, millers who would need either the wheat to go and buy and bake the bread, you know, and they have a vested interest in the physical, to receive the physical commodity. They would then benefit from a weakening. I'll show a couple of examples just to. Here I'm taking an example of basis and the short hedger. We'll just illustrate one case, and then that should suffice for the other as well. Now, this is an old slide that I used earlier, so please bear with me with the months, and the prices may be slightly away from the current prices as we know them today. But suppose it is March and you plan to sell your maize as a short hedger to your local miller by June. So it's in March, and only what, 3-4 months down the road you want to then deliver your maize. The July maize futures price in March, because it is March now, so your traded futures price in March is 1,650 Rand per ton, and the cash price in your area by mid-June. So in other words, people historically know that by June, around June, the difference between your cash and your futures price is normally about 55 under. When we say 55 under, it means the cash price line is below the futures price line. And when we say above, it's the other way around. It's when they are reversed. So in this case, we say that the July futures by March is trading at that price, but we know that by June we do have that basis gap, which is historically recorded. For the purposes of this example, let's see what happens in that case. Now, I'm presenting here 3 scenarios. The first scenario is in the case where we have constant basis. In other words, nothing changes to the basis. And remember what we said in the definition earlier in this previous slide. We said that the historical basis is 55 around June. And since we are talking of a constant basis, we keep it at 55. So, and what are we saying? March, the futures price is at 1650. And because the basis is at 55 under, we can then calculate the cash price immediately, because then it will be this less the basis will give me the cash price. Right. What is the scenario in June? Now, come June, the futures price moved from 1650 down to 1600. But we know that, again, the basis remained constant. So that allows us to then determine our cash price in June, what the spot market price would be. And you see there, if you take this, then less 55 will give us that amount. Now we see that you would argue it's a loss here and a gain here in the futures market. Because the futures, sorry, the basis remain constant, you don't see any difference. So what you lost is what you gain, basically. So what is the net position of the short position holder or the short hedger by June? So by June, the farmer would sell his maize in the cash market at what price? At the going cash market price of 1545. That is the one there. But then he gained 50 rand in the futures market, because he sold at this and is buying back his futures at 1600, gaining 50 rand there. So that gain of 50 rand there, and we see that the net selling price is 1595 rand per ton. So it's in other words 1595 rand per ton. And we see that in June, his net selling price is exactly the same as what we expected in March, because there was no change in the basis. So as a result, our hedge gave us exactly the expected result. Come June, we actually ended up selling our maize in the our overall net income from maize as the farmer would then have been 1595, which is what we expected already way back in March. Let's move to the next scenario when the basis is weakening. Now remember what we said, basis is weakening when it is less positive or more negative. That's the definition, one of the definitions there in that case. So in this case, because we already have a negative, which represents an under, where we say the basis is under the futures price. So it's 55 and it's more, here it became more negative, so it's a weakening basis. So what is the scenario in this case? Again, here we retain the same figures for the futures contract. As a farmer, I sold my position on the futures market at 1650 and I bought it back at 1600. But let's see what the expected cash price would be. In this case, again, it would be this minus that 55 would give me 1955, similar to the previous slide. Now, because come June, the basis actually weakened further. Now we take 1600 minus 60 and not minus 55, and that gives us 1540 instead of 1545. Okay, and that's why you see almost a net loss for the hedger there. So let's look at the hedger's position. He sells his maize in the cash market at the going price, which is now 1540, which is that price we saw there in June. He gained 50 rand from the futures market, and the position is now his net cash, expected cash in his pocket would then be 1590. Remember what we saw, his net position was in the previous slide when we had a constant basis. It was 1595, see there. And now, because of a weakening basis, he is 5 rand worse off, and that is that 5 rand loss that we indicated there. So nothing changed. It's exactly the same structure, exactly the same position, but simply because the basis moved or weakened further by 5 rand from 55 to 60, that negatively affected the short hedger, where he ended up with 5 rand less in his pocket simply because of the basis risk. And that's the one we said it's unfortunately undiversifiable. It's something that you need to live with it and manage, because it's something we can diversify by using the derivative instruments. Right. And I think this also is consistent with what we said in our definition. Let me just quickly get it there. We said short hedges benefit from strengthening basis. In other words, because our example is a short hedger position, and we were looking at the scenario of a weakening basis, the short hedger didn't benefit, and that's why at the end he is 5 rand short than he would otherwise have been, simply because the basis didn't strengthen but weakened in this case. Right. Now let's move to the third scenario where the basis is strengthening. And again, here we are taking a case where it's strengthening by 10 rand, basically from moving from 55 to 45 down. And we, again, leaving the scenario exactly as it is here, with the futures market prices, where in March it was 1650, by June it was 1600. And then, of course, that allows us, by using the 45 here, to determine what the cash market price would be come June. And again, if we look at the final position of the farmer in June, he would have sold his maize in June in the cash market at the going price, which is that one there, 1,555. He gained 50 rand from the futures contract, and the overall position would then be 1605. And clearly, from the first scenario, which we saw when there was no change in basis, he was expected to receive 1,595. Now, simply because of a strengthening in basis, he is actually gaining a 10 rand that you see there. So this is actually what we mean by the basis, or trading the basis as a hedger on the futures market. Let me take you back to the scenario, explain a little bit more on the case of the cost of carry. Remember what we said, the definition of basis. It's a forward curve. It is a cost of carry. It is the difference between your futures price and your cash price. And here I just want to take an example of how a trader can decide either to roll over his position or to rather exit his position now, simply by looking at the cost of carry or between the two contracts. Now, I extracted this information from our database, so it's real information, real experience. Now, suppose it is on the 22nd of August 2014. Now, the August 14 white maize contract was actually expiring, it was expiring on the 22nd of August. So it was the last trading day for the August 14 white maize contract. And the settlement price on that day was actually 1,709 Rand per ton. Now imagine if the trader had to decide either to roll it over to the next position or to simply exit his position, or close his position. He would have looked at the following. Now, the nearest trading month was actually our September contract, which on that particular day was trading at 1,723. Now, the difference arguably between the two would have been the cost of carry. So the difference would then be only 14 Rand per ton between that contract and the following month's contract. Now, we have got between the two there is only 21 business days to the 22nd of September, when the September 14 white maize contract would also come to an end. So it's only 21 business days or trading days. But remember here, because we are talking of the cost of carry being the cost of storage, storage doesn't have business days. You have to store even when it's on a Sunday. So here we would then calculate exactly from the 22nd of August to the 22nd of September, which is a full 30 days basically. Or let's say from the 23rd. Yeah. So we would then look at this is the real experience that of 14 Rand, which we saw on the screens. But here we are now calculating what we think the fair value of cost of carry should have been. So now, let's assume, okay, we know that the 61 cents that you see here is actually the storage rate per day per ton of maize, of white, be it white or yellow maize. So this is now the daily storage rate. And we know that it took us 30 days to store, or we have to make a decision either to store it for 30 days or to exit the position for the trader who's now trading on this day. So he would then do a theoretical calculation to see what is the fair value of cost of carry. And you would see by just applying this formula here, where I simply assumed okay, 30 days times, this is the storage cost is actual because we can't change it. It's published figures and we have to wait for 30 days, so it's actual. But here I assumed an interest rate on capital of 9.25%, which is roughly just around your repo rate basically. But then here we are compounding it on a daily basis times, that's why I divided it by 365 days. And then for the 30 days to the 22nd of September. So if we apply this, and of course using, okay, I see here I made a slight mistake here. It's supposed to be 1709 and not 1706. But it will be roughly that figure that you see there, 12 Rand 97 cents, or maybe let's say 13 Rand something, which is actually below the 14 Rand, what you see here. So you can see that for a trader, this is actually the kind of information he will use to determine or to decide whether he would rather exit his position here, or he is willing to carry the cost to the next month, to the next delivery month, because if it is 12 Rand, or if this number here was below or at 12.97, then it would have made sense for him to actually even carry over. But because it is 14 Rand, actually it is more expensive for him than his theoretical value. So he would rather then exit his position because that number there is greater than this number. So that's how we take our decisions and how we manage the cost of carry, how we manage the basis between the different expiries vis-a-vis the cash market prices. That is, in short, my presentation today on the concept of basis.